Strong selling has hit markets around the world, with the strength of selling exacerbated by how unreasonably bullish shares have been this year. Hi there everyone, welcome to the Trader Circle Weekly Market Update. Today is Tuesday the 6th of August 2024, and before I get started, you do need to be aware that whatever I say is general advice only. It does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. So, I think the biggest turning point for global markets occurred last week with the Bank of Japan. They did a surprise lift in interest rates, and overall, the consensus economic view is that lifting interest rates leads to, a tightening of economic activity, a contraction of economic activity, and an economic slowdown. I don't necessarily agree that that's the case, but that move by the Bank of Japan, where it was a bit of a shock, I think is what sort of started this round of global selling, this sort of panic that sort of swept through global markets. Japan has had 2-3 decades now of no economic growth, no real sort of expansion, and I suspect part of that is the super low interest rates. But regardless, the market's happy to sort of assume that the lifting of interest rates is a bad thing for their economy. Moving beyond that though, the selling accelerated on Friday when we saw the US unemployment data. It basically came in slightly worse than expected. We saw a lift in US unemployment, and up until now, markets have been happy to rally this year on the view that we're going to see a soft economic landing, that we're going to see rate cuts in the US, that earnings are going to remain strong, and that even despite all of that, the economy is still going to grow strongly as well. None of that was ever going to sort of happen altogether. Some of those things might be sort of mutually exclusive. I'm not sure you can get inflation under control while the economy is still growing strongly, while earnings are still growing strongly. If all of that's happening, I'm not sure you're going to see interest rate cuts. So it's my firm belief that for inflation to really come under control, you will have to see the economy deteriorate. You will have to see earnings come down. And I think that was the reality that dawned on investors on Friday. And so we saw a big round of selling from the US then. We saw a big round of selling in Japan. And then we saw some extremely severe selling overnight and yesterday. This selling has been, like I said, exacerbated by how unreasonably bullish markets have been this year. The markets didn't need to drop so much in such a short period of time, except for the fact that they've been rallying so unreasonably strongly up until now. For the US market, there is some optimism there. You can say, well, earnings are expected to hold up for some of these large tech stocks. Interest rates are expected to be cut. Maybe we should see some upwards movement. But that's not the case for a lot of the world. A lot of the world is expected to earn less this year than it did last year, including the Australian market. So I think it's unreasonable for our market to trade on average 10% higher than it did last year, with higher interest rates, with earnings expected to fall, with dividends expected to be lower, with an economic downturn on the horizon. So I do want to just say that, yes, it's been fear selling, yes, it's been a panic, but it's investors' own stupid fault for buying shares up to unreasonable levels. We did have the RBA meeting today, and the RBA basically did what they've done for the last 6 months, and that is a copy and paste job. They did change the wording a little bit, tried to distract from the fact that they hit Control-C and Control-V, but it really was the same sort of statement they've had for months on end now. They didn't really allude to, the inflation re-accelerating too much. They just sort of said it's been holding stronger than expected, and, basically stronger than their May forecasts. Didn't really allude to sort of, any sort of amount above or amount below, or what conditions they'd need to see for further rate rises, what conditions they'd need to see for rate cuts. They just continued with the line that they're not ruling anything in or out. So no tightening bias, no easing bias, just basically waiting and seeing. Really was a bit of a nothing statement, was a bit of a stable statement, perhaps a bit of a lazy statement. But it was kind of what the market needed to see on a day like today. When a market is swept up in panic and sentiment, that sort of stability, that sort of, calmness, no real sort of change to behavior, I think sort of did calm the market a little bit. And we did see our market jump sort of up to 20-30 points after the statement was announced, and then we pulled back to close sort of 10 points higher than where we were before the RBA statement. Overall, the RBA really is not really committing to anything because I suspect they're going to end up following what happens around the world, particularly in Western nations. So we're expecting to see a US rate rise in September. After that comes through, I do think we'll start to see Australian imported inflation be reduced a bit, and that's because we will have, the firmer or relatively firmer monetary policy that could keep the Australian dollar strong, and that might reduce imported inflation. So eventually, I think if the RBA holds, it will be almost like an implied rate rise, and that'll give them sort of, reduction in imported inflation, and then eventually perhaps a reason to cut rates early next year. So I think the RBA at this point is basically waiting for everyone else to cut, and hopefully that brings down our own inflation as well. So looking forward to our market, there's still a lot going on. I don't think we're out of the woods with the current round of volatility. I think there's a fair chance that we see a little bit of a bounce back up from global markets, just as some of people who went short close out, some of the people who panic sold buy back in, and some bottom feeders come in. And I think that could push things up for a few days or a week. And then I'd be looking potentially for a lower peak, some other sort of catalysm event, something else to sort of push things back down. I don't think we're out of the woods with the volatility. So yeah, like I said, short term, a little bit of a bounce back up, and then we'd be looking to see if there's a lower peak on markets or not. The next major thing coming up for the Australian market is the company earnings reporting season, and that does kick off this week. Well, technically it kicked off last week with Rio Tinto, but the majority of Australian-based companies report from this week onwards. It starts in earnest on Thursday. We've got Transurban, AMP, News Corp, and a few others on Thursday, Mirvac I think, and it continues up until the end of the month. If you are looking to do a trade or investment at the current time, make sure you first check the reporting calendar. Consider how any report or dividend may affect your trade. There's reports up until the end of the month, and then dividends up until the end of September. So let's have a look at the charts for this week, guys. This is the S&P 500, the US most broad-based share index, and we can see that with the unemployment report, they've actually broken their longer-term uptrend line. They are still on a longer-term uptrend. They've still got the higher peaks and troughs, but now we're looking to see where the trough is, where the next peak is. If they do push up, for me, they'll have to go above 5250 for further gains to look likely. And if they go above that level, we're then looking up towards sort of 5350, 5400. If they fall back off from here, we're looking towards the support level at 5000 and the 200-day moving average. And really those levels aren't too far away, given how quickly the market is moving at the moment. Overall though, I would expect, like I said, to stabilize around here in the short term, and then we'd be looking potentially for a lower peak than the peak we saw last week. So we'd be looking for a peak below that sort of 5550 level. If we have a look at the XSHO, the Australian share market, we can see that we've come back to a bit of a support level as well. We've come back to the support at roughly 5650, 5630. This was our level in late May, and if we do close below this level, we're then looking at that 200-day moving average and that sort of 7500 level, our roughly yearly low support level. If we do bounce from here, I'd be looking for a move towards 7830. That was our resistance for all of sort of June and July, and we did break that, that was our resistance for June. We did break that in early July, and then we sort of slammed through it in Monday's session. But if we do push up from here, I think that's our first upside target. Overall, it's tempting to say that our market looks cheap after a 5% fall, but in reality, we still aren't cheap at these levels. We're extremely expensive, historically expensive, and that's not even when you consider just how high interest rates are as well. Keep in mind our company earnings are going to be sort of 6-7% lower this year than last year, and yet our share prices are still 10+% higher on average. Given that's the case, I would not be sort of trying to find value on the current bottom move. You could consider a short-term trade based on a rebound, but there isn't a whole lot of value in the market as a whole at these levels. Some of the materials and perhaps energy stocks will pay great dividends and might represent value here, but outside of that, the rest of the market still looks quite expensive. So I will wrap it up there for this week, guys. Hopefully you enjoyed. In the comment section, give us a stock code that you're looking at for the reporting season, and we'll see you guys next time. Bye for now.